All right, let's jump right into this. Welcome to today's Explainer, where we're going to perform a corporate health check on Centerspace. They are a real estate company navigating a truly fascinating transitionary period in 2026. If you follow residential real estate, you already know the market right now is a complex puzzle of shifting valuations and strategic pivots. And Centerspace's recent Q1 2026 earnings report is literally the perfect case study. To make sense of their dense earnings report, we're going to follow a pretty clear roadmap. Meeting the company, running the Q1 diagnostics, looking at their strategic treatment plan, forecasting the prognosis, and finally, getting Wall Street's verdict.
So, Section 1. Meet Centerspace, the baseline health.
Centerspace is a real estate investment trust, or REIT, operating just over 12,200 apartments across states like Minnesota, Colorado, and Utah. You'll notice they're completely avoiding those highly volatile coastal markets. Instead, they planted their flag in regions characterized by really strong demographic trends. Think higher than average employment and steady household growth. And honestly, their internal operations are looking incredibly solid. We're talking multiple top workplace awards, plus a stellar GRESB score of 71 for environmental and social governance. But here is the absolutely crucial metric for us. Their resident rent-to-income ratio sits comfortably between 18 and 25%. That easily beats the national median of 30%, which means their tenant base is highly financially resilient.
When you add all of this up across their entire portfolio, you're looking at a total capitalization of $2.2 billion. So yeah, they are definitely a serious, significant player in the residential real estate space.
Moving right along to Section 2, Q1 2026 financial results. The diagnostics.
Now, before we dig into the actual numbers, let's quickly touch on Core FFO, or Funds from Operations. As you probably know, in the real estate world, standard net income gets completely skewed by massive depreciation deductions. Buildings age on paper, sure, but the cash isn't actually leaving the business. That makes Core FFO our undisputed measure of a REIT's true cash-generating health.
Looking at the data, we've got a stark contrast that might initially spook a casual observer. On paper, there's a widening net loss of 77 cents per share. But look at the Core FFO. It sits at a very solid $1.12 per share. Now yes, that is a 7.4% drop year over year, but context is literally everything here. That dip is primarily because they purposefully sold off 12 apartment communities in the prior year. Fewer properties naturally means less total cash flow, but it was a very deliberate strategic move.
So how does the day-to-day actually look? Well, it's a bit of a mixed bag. Same-store net operating income did dip slightly by 1.1%, but the bullish counterweight here is undeniable. Their weighted average occupancy remained incredibly robust at 95.4%. People are staying, and the apartments are full.
And to weather any short-term bumps in the road or unexpected market shocks, they maintain a very healthy liquidity pool of $267.1 million, mostly sitting in available credit lines. They absolutely have the cash flexibility they need right now.
Which brings us to Section 3, the strategic review, the treatment plan.
Management is not just sitting on their hands. They are actively reshaping this portfolio to optimize for the future. We're talking $245 million in planned dispositions. They're exiting the St. Cloud, Minnesota market entirely and actively dialing down their Minneapolis exposure from 33% to 31%. And they're taking all that capital and pivoting toward faster-growing demographic hotspots, like expanding into Salt Lake City.
But here is the massive wildcard you need to watch. The board of directors has brought in financial and legal advisors for an ongoing review of broader strategic alternatives for the company's future. What does that actually mean? Well, it could be anything from a major merger to a massive structural shift. It's a huge variable, and management has promised a substantive update by the second quarter.
Okay, Section 4, 2026 Outlook and Guidance, the prognosis.
First, to really understand their outlook, we have to look at how they're funded. Their capital structure is pretty balanced, 52% common equity, with the rest split between secured and unsecured debt. It's a nice diversified mix designed to spread out the risk.
Now, Wall Street has definitely noted a potential point of friction. In Q1, their leverage was somewhat elevated, sitting at an 8.2 times net debt to adjusted EBITDA ratio. And let's be real, in today's high interest rate environment, heavy debt can be a silent killer for real estate firms.
However, and this is exactly why you have to look past the headline numbers, that debt is actually highly manageable right now. Why? Because they locked in a staggeringly low weighted average interest rate of just 3.6%.
Plus, their maturities are laddered out over an average of 6.7 years. This brilliantly shields them from the immediate chaos of current rate hikes. They simply don't have a massive wall of expensive debt coming due anytime soon. Balancing that stable debt with the ongoing portfolio reshuffle, management confidently reaffirmed their 2026 guidance. They expect Core FFO to land between $4.81 and $5.05 per share. The midpoint of this guidance is literally exactly in line with their 2025 actuals. It represents modest, steady expectations while they execute their broader strategic transition.
Finally, let's wrap up with Section 5, Wall Street's verdict.
10 analysts polled by S&P Global currently give the stock a consensus hold rating. But don't let that hold fool you into thinking there's no momentum here. Their average price target of $67.56 implies a rather massive 18.5% upside from recent trading levels around $57. Even the most pessimistic analyst on the board sees over a 12% gain. The why behind that upside is largely driven by a clear disconnect in the market. Right now, the public market is pricing Centerspace at roughly a 10% discount to its consensus net asset value, or NAV. Basically, the stock is trading for less than the physical value of its concrete and drywall.
Which brings us to the ultimate question for anyone watching this space. As Centerspace transitions its portfolio to higher growth markets, and as the board weighs massive strategic alternatives in the background, you have to ask yourself, does this discounted valuation represent a lingering value trap, or is this a prime hidden opportunity just waiting to be unlocked? That's what we'll be watching as that Q2 update approaches. Thanks for joining me on this explainer, and keep learning.